Hi there, welcome to Kneppy Invest. Continuing on in my looking at companies' financial year 22 results, I'm going to focus on a company called PWR Holdings. Now, this is, in my opinion, a high quality company, yet it is quite expensive. In fact, I would love to own this company, and I have been a shareholder of this company in the past, and I was probably being a little bit too smart. I decided to take some profits and on the thought that I would able to buy into this company at cheaper prices, yet the share price has gone up since then. So look, I think that is a mistake, and I think it's very important to learn from your mistakes as an investor, particularly when it comes to high quality companies. So what does PWR, Advanced Cooling Technologies, actually do? Well, it's all in the name, Advanced Cooling Technologies. So some of their products include tube and fin heat exchangers, bar and plate heat exchangers, additive manufacturing, liquid cold plates, micro matrix heat exchangers, performance aftermarket products, and some of the markets they sell their products into include motorsport, including F1, defense, OEM, aerospace, electric and hybrid vehicles, aftermarket, renewable energy, and industrial. And really, this company has been gaining traction over the past 10 years. Really impressive growth profile. And I think the potential for continual growth in the future is definitely there. And that's one of the reasons I consider this company to be high quality. Not only that, they have a definite moat, a definite competitive advantage, and they also building a brand. And that's really important in keeping the growth profile going in the future. So that competitive advantage, that brand will be able to set this company up for some really good times over the next decade. I am really enjoying doing these financial year 22 result videos. And one of the reasons I like doing these videos is because I am doing research on companies I have never had a look at in the past, and more than likely would never have a look at if I wasn't doing these videos. And some of those companies include IMDEX or IMDEX, GUD Holdings, High Tech Group. I've had a tiny look, a brief look at NextDC about 2 or 3 years ago. So I haven't had a look at that yet. But once I prepare for that video, it'd be really interesting what I think about that company, because I do know there are a lot of fund managers, a lot of commentators who love that company for some reason. So hopefully I'll be able to find out why they love that company. And the fifth company I'm going to have a look at in the next 2 weeks is Fiducian Financial Services. I do know this company a little bit better. And in fact, I am a shareholder, and I hope to be a long-term shareholder of this company because I think, in my opinion, Fiducian Financial Services is a high-quality company. Whenever I'm doing research on a company, the first thing I want to know about that company is whether it is a high-quality or low-quality company, because the way I treat high-quality companies is different than how I treat low-quality companies. And I've sort of already given it away that I do consider PWR to be a high-quality company. So for PWR, it's all about the value. I don't care about the share price trend. Don't care about the sentiment. I'm looking for the share price to pull back a significant amount, and I'll tell you about what share price I am looking at for that pullback. And if I do see the share price pull back to that level, I will take a position in this company, because at that level, I do think there would be some value. So I'll talk about that value probably when either we look at the valuation slide or maybe even a chart slide. You probably could determine the quality of a company just by looking at the long-term chart. And this is PWR's long-term chart, so weekly chart going back to when the company listed on the ASX back in 2015. And the way you determine the quality of a company is if the share price has increased and is in an uptrend over the lifetime of the chart. That's when you could say maybe this is a high-quality company. And I would take that argument, because the share price of PWR has increased from $2.50 to a high of about $10.25, which we have seen reach 3 times in the past year. So there is a possible triple top developing in PWR's share price. And we'll have a look at that, and I'll discuss that when we look at the daily chart towards the end of this video. Now, I became really excited in this company back in around about March of 2021 when the share price broke out. So that share price breakout was at about $5.25. And you can see I've put a little bit of a horizontal line at that level, and the share price broke out on I think this was in February 2021, broke out on the half-year results. And that's exactly what you want to see when the share price breaks out on good financial news. And then the share price went from around about $5.50 all the way up to above $10 in, we'll say, about 8 to 9 months of trading. So that's the time I was a shareholder of this company during that re-rating of the valuation of this company. And since then, since the highs we saw back in October last year, share price of this company has been very volatile. You can see the share price swinging between about $10.25 and a low of around about $5.50. Not only that, between about April and June of this year, we saw the share price decrease almost halved, in fact, during that 3-month period. And then there was a V-shaped recovery. And that was just a wild swing in sentiment around this company. And I think one of the reasons why there was a wild swing in sentiment was just because the share price got just above got it down to about $5.50. And that's the level a lot of investors, a lot of fund managers saw really good value in this company. So if I do see the share price get down to that level again, I will most definitely take a position in this company. Now onto the financial results for PWR. And before we have a look at the revenue, profit and operating cash flow, at a share price of $9.40, the market cap of PWR is 950 million, or just a little bit less than 950 million. So there is about 100 million shares on issue for this company, and that has slightly gone up over the past 6 or 7 years since they IPO'd. Now onto the revenue for financial year 22. $101 million of revenue, nice margins. So with that $101 million of revenue, they brought in $20.8 million of profit and $15 million of operating cash flow. Reported operating cash flow was about $2 million more than that, but I do take away leases because leases is an expense, a day-to-day business expense in my opinion. And I think, in my opinion, this is just my opinion, you do have to take that into account when you look at operating cash flow. The key word there is operating. And the earnings per share for this company is at 20.8 cents. So you can just see, compare that 20.8 cents of earnings, look at the share price of $9.40. You can just see that straight away, the PE ratio of this company is somewhere between 40 and 50, maybe 45 to 50 in that range. So again, one of the reasons, one of the negative things about this company is just the current valuation. So the market right now is willing to pay a premium for this company. And one of the reasons it's willing to pay a premium is because it is a high quality company. Now into the revenue growth for PWR. And this is one of the first steps I make in determining the quality of a company. I want to see revenue growing through time. And for those who don't know, there has been research done on this. And this is one of the best predictors for total shareholder returns beating the market. Yes, it is revenue growth over time, not profit growth, not operating cash flow growth or free cash flow growth. It is actually revenue growth. But you can't just look at revenue growth alone. You do have to delve a little bit deeper, particularly focusing on margins. So in this slide, we're going to look at total revenue growth. And then the next slide, I'm also going to look at margins, profit, and operating cash flow. But the main thing here is the revenue has been growing for this company at a consistent rate. Every single year, revenue has been stronger than the year before. And in fact, since 2013, the first year we have had financial numbers for this company, that was not the year they IPO'd. They IPO'd in 2015. But when a company IPOs, they do provide 2 years of financial history. That's why we can go back to 2013. But revenue has grown from 16.6 million to 101 million. If we calculate the compound annual growth rate of revenue, and this is revenue per share, it has grown at 22.2% since 2013, 15.6% since 2017, and 15.5% since 2019. So that is real solid growth in revenue. I'm looking for growth in revenue above 10%. In fact, we don't want too strong in growth in revenue. We want solid revenue growth, probably between about 10 and 20%. That's probably my preference. And the reason I don't want too solid growth in revenue is simply because that might be telling me that the focus of management is in revenue growth and not profit and operating cash flow and free cash flow. I've seen this a lot with tech companies, particularly in America, where management is solely focused on growing revenue above everything else. I think management should be focused on revenue growth, but also maintaining margins or increasing margins and becoming profitable and free cash flow positive. So that's one of the reasons why I don't want to see massive growth in revenue, but I do want to see a solid 10 to 20% revenue growth over the long term. And that's exactly what PWR Holdings is doing over the last 9 years. So in this particular slide, a little bit messy, but I've just included cash flow from operations, profit, gross margins, and operating margins. So what I want to see with margins is I don't want to see it dropping through time. And the gross margins is in the green. And over the past, we'll say 7 years, gross margins have gone sideways, really between about 77% and 80%. So that's pretty good gross margins. If I see gross margins starting to fall, that would be a negative sign that there is potential that this company is losing competitive advantage. They probably have to do discounts to their products, that sort of thing. And if I do see operating margins or gross margins starting to increase, that would tell me that this company is definitely building a brand. So I'm keeping a close eye on the gross margins of this company moving forward. And even the operating margins, you could argue they have been dropping since about 2014, but over the last 5 or 6 years, again, they've been flat and not really increasing or decreasing. But what has been increasing has been cash flow from operations and also profit. Now, not on a consistent basis like revenue. So when you do look at profit and operating cash flow, you've got to see a little bit more lumpiness in there. And that's one of the things, or one of the reasons why I do like to look at revenue growth above all else. And again, research has shown that the best indicator of total shareholder returns beating the market returns is revenue growth over the long term. To understand why operating cash flow has fallen from last year, you could look at the note if you actually go back, I'll just go back to the previous slide. So note C1, that will give you a reconciliation of cash flows to profit. So you will get an understanding of some of the reasons why operating cash flow has dropped. But in PWR's presentation, they did give a cash movement analysis. And in this cash movement analysis particular slide, they do have some of the things they would show you in that reconciliation of the cash flow found in note C1. The main thing I'm looking for here is changes in working capital. So we have net working capital of $17.5 million in financial year 22, $11.3 million in financial year 21. So straight away, we know there has been an increase in working capital, and that increase in working capital was $6.2 million. So the changes in working capital revolve around trade and other receivables, trade and other payables, and inventories. And the right-hand side, they have explained some of this. So they've mentioned here, financial year 22 includes $6.2 million increase in working capital, including $4.5 million increase in trade debtors due to strong June sales. So that's really important. Due to strong June sales, some of that strong June sales is going to translate into financial year 23. And this could be a sign that maybe financial year 23 is going to be good for this company if June sales are pretty strong. Now, if we take into account changes in working capital, raw material investments, cash flows from operating activities have not changed all that much from last year. So last year, they were $33.3 million. This year, $33.3 million. So that is a slight concern in my opinion. And free cash flow has dropped from $16.1 million to $12.1 million. And there has been a significant drop in capital expenditure from $10.4 million to $4.9 million. So even though I do consider this company to be high quality, the one concerning thing for me when I did look at PWR's financial results was that flatness in cash flows from operating, taking away changes in working capital and raw material, and that drop in free cash flow. But on the flip side, I was really encouraged by the fact that they did mention that there is strong June sales. Now to some valuation metrics of PWR, and because I consider this company to be high quality, these numbers are very important. If I saw the P ratio for this company at 15.7, I would be taking a position in the company because I would say, based off historical valuations of this company, based off future potential growth, I will consider this company to be cheap at those prices. But right now, The PE ratio for PWR is 45.7. Price to sales ratio 9.4. Price to operating cash flow 63.3. That is fairly high as well. And I also did a reverse DCF. So what is the growth rate needed to justify the current valuation? That is a reverse DCF. So this company needs a 24% growth in earnings per share. I use earnings per share, not operating cash flow. If I did use operating cash flow or maybe free cash flow, you would need a 31% growth in free cash flow to justify the current valuation. Now, I do believe that this company can meet those growth rates. But if you do want, say, a margin of safety, that sort of thing, you might want to wait till the share pulls back a little bit. And that's why when the share price pulled back to $5.50 back in June, there was a lot of interest and a lot of buying that came in because the valuation of this company became more attractive based off the future potential growth of this company. The next two slides I'm going to look at are taken directly from PWR's Financial Year 22 presentation. So I highly recommend having a look at the presentation, any company releases, because you do get a lot of information in these presentations. And I like this particular slide because it breaks down the revenue generated into the different markets. So motorsports, automotive OEM, automotive aftermarket, and aerospace and defense. It also breaks it down into advanced cooling and emerging technologies. And I really like the emerging technologies because this includes revenue from aerospace and defense across all technologies and revenue from other market sectors generated by cold plate, micro matrix and additive manufacturing. And that has been growing at a fairly quick rate over the past year. In fact, emerging technologies revenue has grown from 8.7 million to 19.4 million. So even though that has more than doubled in the past year, advanced cooling has also grown from 70.5 million to 81.6 million. But I'm particularly interested to how emerging technologies can grow in the future, particularly if there is stronger margins in that, and particularly if they have a significant competitive advantage. If these emerging technologies, some of their products can't be replicated by other companies, that would be very exciting for this company and the shareholders in the future. Now, if you broke it down into the different markets, by far, the most revenue is generated in the motorsports. So about 55% is generated in the motorsports, 21% in automotive OEM, 16% in automotive aftermarkets, and only 7% in aerospace and defense. So aerospace and defense is that emerging technologies area. And they've all grown. All different markets have grown in the past year. Aerospace and defense at 56%, motorsports 23%, automotive OEM at 65%, and even the worst growing market grew at 6%, and that is automotive and automotive aftermarket. And in this particular slide, focused on the aerospace and defense market, and remember that is emerging technologies. They do go into some of these emerging technologies. For instance, electric vertical takeoff and landing. They mention this is a high future growth area for the company, with several aerospace manufacturers turning to the company for thermal system support and manufacture. And another interesting, fascinating area they're getting into is hydrogen fuel cells. Now, this sort of cooling technology has been a focus for the company, providing lightweight and compact solutions to allow their customers to increase energy density of their platform solutions. So I just find some of this technology really fascinating. And that's actually another reason I really like this company, because of what they're doing. And even though some of this might go over my head at times, it's just a fascinating futuristic look at how the world might be in regards to cooling systems. Now onto the daily chart, and this goes back to April 2021. And when we looked at the weekly chart, I talked about this double top, and that double top is around about $10.30. We saw the share price of PWR reach $10.30 the first time back in November of last year, and then again in May of this year, and then again very close to reaching that top a few months ago, or 1 month ago. And as soon as it reached $10.30 in May of this year, the share price collapsed from $10.30 all the way down to a low of $5.60. So you just see share price absolutely fell off a cliff, but then there was that V-shaped recovery. Now, I've also put in a support level at $5.20. If the share price had hit that level, in fact, I put in a bid at $5.25, I would have been a shareholder of this company, but the share price didn't quite get there. So that was a mistake on my part. When I saw the share price get below $6, I really became interested in this company. The share price only stayed below $6 for 1 day. So sometimes you can be too smart when you just say, well, if the share price falls to a certain level, I'm going to take a position. I should have just taken a position when the share price fell below $6. So right now I am waiting for another decrease, another dip in the share price. And if I do see the share price fall probably below $7, that's when I would become keen in taking a position in this company. Probably a small position. And in fact, I am thinking about just taking a small position right now. And if I do see the share price drop down to say $7, $6.50, or even $6, I will add to my position at those levels. But if the share price increases from here, well, I've got a small position. So that's okay. So that is another way I also play high quality companies, taking a small initial position and then building on that position. You might say averaging down, but it's okay to average down on high quality companies, in my opinion, because you're getting better value. I think it only works for high quality companies because over time, the share price of high quality companies should go up. So that's how I'm playing PWR right now. I'm not a shareholder of this company. I want to be a shareholder of this company, but I'm just remaining patient. But I don't want to be too patient like I was back in June. That's all I have for this look at PWR's financial year 22 results. This is a high quality company, in my opinion, just my opinion. You could have a different opinion. How we perceive companies or the quality of companies is up to the individual. Now, even though I do think this is a high quality company, right now it is a little bit expensive. P ratio around about 45. And if I do see the share price pull back, say the share price falls from, what is it, $9.50, say into the $6 range, that means the P ratio would be dropping down towards 30. If I see the P ratio drop below 30, I would become really interested in this company simply because the future potential growth of this company is or could be very impressive. And that's just my opinion. Of course, if you do further research on this company, you could come to the complete opposite opinion to mine. And if you know any more on this company, if you have any questions, any thoughts, please leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.